What is up, guys? Thank you for sticking through that commercial break. As promised, a new episode of Fed Watch. CK, Ansel, take it away, boys.
We got a good one for you.
Oh, yeah.
How's it
Everybody,
going?
welcome back to another episode of Fed Watch. It is a macro show for Bitcoiners with a contrarian twist. We have made some contrarian calls on the show, and they have worked out better than we could have ever dreamed. But we are live recording on Bitcoin Magazine's live stream. So for all those people that join in later on the audio version, mark your calendars for 3 p.m. on Tuesdays. We will be live streaming at that time every week. So come join us. Today, we're going to be watching some press conference highlights from Powell and Lagarde. So they both talked in the last 2 weeks. We haven't really covered that on the show here yet. So thought we'd go over that today. But before we do, Christian, welcome back. How are you doing? How are you handling the Bitcoin winter?
Oh man, what winter? I'm just excited to be able to increase my SAT denominated stack. It's only going up, so pretty hyped about the prices, and I'm pretty hyped to be in BTC Studios here, officially in Nashville now. So a lot of fun to be had here in Nashville, and I'm excited to make this room look a lot cooler and bring a lot of energy out of Nashville instead of San Francisco. But without further ado, let's get back into macro. A lot has happened. I mean, Ansel, we can talk about Fed raising rates despite what seems to be an economic collapse upon us. The economy potentially moving into a recession. This to many is thought that the Fed would be behaving in this way. But so I guess back to you, Ansel. What do you think? And maybe we should jump into some of these videos.
Yeah, tons happening with the Fed. We had Tone Vase on last week. Great show. So if you guys haven't seen that, go back and check that out. We didn't get into the Fed very much at all. We talked a lot about Bitcoin, a lot about the Bitcoin cycles and that kind of stuff. So this week, we're kind of catching up on some of these things that we have let slip a little bit. But we do have Powell's speech. I took 3 clips. And I don't think, Christian, you had a chance to watch these clips yet. So it's going to be a cold reaction from you, which should be great. And yeah, then we go on to Lagarde, same sort of thing. She kind of came out and, talked about their upcoming policy decision. So we have 3 clips from her. And we do this because we like to get the word straight from the horse's mouth. We like to get the, make our own decisions, watch what they say, get a feeling for how they are in front of the camera. If they're lying to us, we can kind of get the spidey sense where we don't believe something or we think they're being dishonest about certain parts or honest about other parts. And people should expose themselves directly to the source. That way they can make up their own minds. But that's all I have for the lead in. Should we go right into Powell's first clip?
Yeah, let's definitely do it. And I guess, do you want to give any context before Chris puts it on?
I mean, this is their press conference after they come out with their decision. So the way it works, when the Fed makes a policy decision, they will release it on their website. I think it's like 2:30 p.m. And then about a half hour later, Powell comes out and talks to the media. He has a prepared statement, and then he takes questions. So that's what we're going to be watching clips from.
Let's get into it.
Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices.
All right, Christian, you want to go first? What was your cold reaction to that? Any insights?
I mean, I feel like I have less insights than you will, but generally speaking, he kind of stated, a little bit of the obvious, which is we're increasing rates, and therefore, we're seeing some of the the housing market is becoming, is cooling down a little bit. We're starting to see changes in consumer behavior due to the increase in rates. But on the flip side, it just, I didn't get a whole lot out of it, I guess. Even when he was talking about what's happening in the labor market and how that's not really changed. I did see some articles talking about how all of a sudden, because the wealth effect is gone, people are showing up for their minimum wage job again. We'll see if that actually plays out. But what he's saying is that nothing has really changed, and maybe it's too early to tell if that dynamic has changed. But ultimately, when I look at jobs and what how people are choosing to spend their time, my base case is that is really distorted because of the economic hurricane that we find ourselves in. Nothing really makes sense. It's difficult to allocate capital, and therefore it's difficult to allocate your time and spend your time doing something that creates value but is fulfilling as well. So that's like one of the underlying issues with what is happening with a fiat-based world. So not to go on a tangent, but I guess I'm very curious with what you think, Ansel, and I'm sure that you have a lot more insights to pull out of that.
Well, I love that you brought back in the economic hurricane, because we did hear that recently from Jamie Dimon at JP Morgan. And I tweeted, I said, yeah, we've been talking about that for over a year. But so yeah, on this particular
there's video
clip,
evidence.
Yeah, there's video evidence. On this particular clip, what I pulled out was he talked about some levels of economic growth and economic performance, but he didn't clarify whether these are nominal levels versus real levels, because with us, CPI going up at 8%, we could see real levels of economic activity falling by 7%, and they would still look slightly positive, right? So I think there's a little bit of wordplay happening here, a little bit of sidestepping, making some hard calls on Powell's part. And that's different for us, because we usually think that Powell is relatively a straight shooter. We've said that in the past here on the show. So I think
I guess it's easy to be a straight shooter when rates are going down, not the other way around.
Yeah, that's true. He's having to make some semantic choices here, because again, they aren't in control of these things, and he's trying to massage the message. So it's understandable.
Yeah, that's a really good observation. This is why I love listening to you talk about what's happening with the Fed, because I feel like you understand the dynamics of the person delivering the news or making the decisions a lot better, and you can pick that out.
Yeah, and he also said something we picked out previously was when they can't affect supply, they can only affect demand. And he says in here, in this little clip that we just watched, is that tightening financial conditions should continue to temper growth. So obviously, to me, that means that they're trying to induce a recession. And but later he's asked that direct question, which we will listen to here in a couple clips from now. But so they are trying to induce recession, tamp down on demand so that prices come down. He also said here that the labor force participation rate, or he talked about that, he mentioned that, and that was the only time in the entire 1 hour press conference that he mentioned the labor force participation rate, even though employment is one of their, is half of their mandate, maximum employment. And he only talked about labor force participation once. So I thought that was really interesting. But one thing that we didn't include in the clip because, we're limited on what we can show here is he did acknowledge also that oil prices are responsible for a high percentage of the CPI price increases. So I thought that was very interesting. Of course, he doesn't hammer that home or explain that anymore, and nobody asks the question. So he says oil prices are, responsible for a lot of this, but then he just moves on. So that's all I have for this clip. Should we move on to the next one then?
Yeah, no, I think so.
All right, let's do it.
We can't hear him. Having some technical difficulties.
A few technical difficulties.
Hopefully the producer is going to get figured out. Oh, here we go.
Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected.
All right. So, Christian, do you want to go first again? This one, he was talking about adaptive monetary policy and kind of long-term projections and where he sees the rate going in the future.
Yeah, I mean, he's at least trying to set the expectations that rates are going to continue to go up. And really, the impression that I got from him is he is like, I am the doctor and the economy needs to take its medicine. So that's the impression I got from him. And he was like, hey, it's tough, but here's the medicine that we need to take.
Yeah, a couple words he used there, adaptive, he used that a lot. He used nimble. And one of the things from this rate hike was, it was projected at 50 basis points. And then only about 48 hours before the announcement, things started changing rapidly towards 75 basis points. And then they came out with 75 basis points. So they were adaptive and nimble to the situation. They did actually pivot, but they pivoted a little bit more hawkish instead of a little bit more dovish, right? And so I think what they're trying to do, or what he's trying to do here, is build in an expectation of future pivots. I mean, they are adaptive and nimble. He kept saying that over and over. So what do you think about that?
That the myth of the central banker is that they're this adaptive and nimble institution that keeps the economy in balance. I think that Bitcoiners already either don't believe in the myth or they think that their presence is detrimental, and that's why we're bullish on Bitcoin, because Bitcoin is a uncorruptible and a opt-in monetary policy. So you agree to run the rules and no one can change it. So you have assurances there. We think that is much more stable way to do things. So that's like the myth. And, I think that he's trying to expectation manage that reality like he has been. But I've been kind of harping on this idea that the Fed, has this golden goose, which is that, it has thus far been able to kind of manage expectations the way they want to. But what is really happening is the economy is actually doing things in the background, and they're finding ways to appear to kind of flow and stride with that. But I think that with these recent rate hikes, when they stop rate hiking, and things may not respond the way that they want the populace to respond. And I guess what I'm trying to say is that I think that they potentially could have killed their golden goose. They may have, by really pushing us into a recession, they may have put themselves in a situation where they can't save the economy. And then what? Once we're in that recession, they can't save it because they actually don't have power. The king, is caught without his clothes on. And I think
Yeah. I didn't get that last bit there.
Sorry, no, I said, and I just think that that's very dangerous for them.
Yeah. I think what I was trying to point out was that Powell is almost like trying to create this MO that they can adapt their monetary policy very nimbly, and they can move, 75, it's okay, 50, it's okay, 25, it's okay. It doesn't really matter if we're going to do this, but we're going to do what's best. And I think that is kind of dangerous, because people expect them to know what is, be very confident in what they're doing. So I think that could work against the confidence of the Fed going forward. One thing I wanted to ask as well was, this is kind of related because he talked about quantitative tightening there, is do inflationists think that quantitative tightening is deflationary? Because we heard for 12 years that QE was inflationary. Well, is QT deflationary? And what's your take on that whole narrative there?
I think QT and QE economic chaos, and ultimately the system can't really it takes a while for the system to kind of adjust to accommodate for them, and then when they manipulate those things, it just creates more chaos for the economy to try to deal with, and for individual economic actors to deal with. So whether one does something or another, I think it's impossible to tell what they actually do, because it's all kind of going into a blender of craziness. But I do know that they create chaos. So the more that they are used and changed and destabilized, and the more change that is being done via intervention, I feel like that creates chaos. So I don't really have a strong opinion about what one actually leads to, but I think that they both create chaos, and they both make it difficult for individual actors on every level to make sense of what's happening. And again, that's why I say that's why we Bitcoin.
Absolutely. He also talked there about inflation expectations, and I prepared a few charts. If we could pull up chart number 1, if Chris has that going. Maybe. I had a lot of material for you guys this week. Behind the scenes, guys.
Chris is on top of it.
Yeah.
Thank you very much, sir.
Yes. So not showed here, but I want to mention it before I talk about this, break evens, is the Fed does a survey of inflation expectations. And that's what he talks about a lot here, Powell, in this press conference, the Fed's inflation expectations. And again, that's a survey, and it's showing over 8%. All right. Now, it's hard to square that with these charts that I'm about to show here. This 5-year break even is the difference between the inflation adjusted 5-year treasury and the inflation protected treasury. So this is a market rate directly from the market, and it's showing that it's the expectation on the 5-year break even is, I believe it was 2.8%. And then if you go to the next slide, is the 10-year break even, and that's showing 2.4%. So that is the expectation, the average inflation over the next 5 and 10 years by the market is basically about 2.5%. The next chart I have is the 5-year forward, and that is the kind of gold standard or the Bitcoin standard of inflation expectations, and that is the second 5-year period from today. So not 0 to 4 years, but 5 to 10 years out, and what the market is expecting for that period. And so this is not a survey. This is based on a algorithm calculating different interest rates, different things like that. And it's showing the same 2.4% roughly. So all of these numbers, the reason why these are lower, in my opinion, is that this is actually the measure of inflation. This is actually the money printing side of CPI. So the other half, so from 8.6% or whatever we have for CPI compared to this 2.4%, so that's 6.1% of the CPI is from supply chains, the supply chain disruption, oil prices, food prices, that kind of thing, due to the war over there and the sanctions in Europe. So that is what I take from this. And when Powell talks about inflation expectations, he's looking at CPI expectations and not monetary inflation, actual printing of money. So that's all I have for these charts. Christian, what are your comments on
I
that?
would love to stay on these charts and just kind of talk about it a little bit. Like, I think this is the basis of our quote unquote unpopular opinion on this show, is that it's very difficult to tell what is inflation, because everyone is using different definitions of that. So,
Yeah.
And then what the CPI captures does in any index that's trying to quote unquote capture inflation, that's not strictly counting like notes being printed, or what you're showing is expectations of inflation in terms of pricing, then what it's doing is it's capturing disturbances maybe in prices, but it's not actually capturing quote unquote money printing. It's capturing disturbances. So those disturbances could come from anywhere. Right now, there's an enormous amount of disturbances. There's sanctions on key commodity providers. There's war in key commodity and food and wheat providing region, in a resource-rich region. There are global supply chain disruptions because of COVID lockdowns and changing health movement protocol and differentiating health movement protocol across the globe. Like, there are a lot of just crazy curveballs being thrown at ordinary people trying to do business, right? And that affects prices. That affects how many things can get on ships and get transported, and how many things can get built in a factory, and how many things can get grown and produced into food, and how efficiently that can happen. All of that is being disrupted right now. And we're not even talking about, the fact that oil is kind of like a base price increase on everything, because everything pretty much requires oil directly or indirectly.
Absolutely. And a lot of people might question, why are they being sticklers for this? Why do people care where the inflation is coming from? The prices are going up, but that you need to identify the proper source of this if you want to make rational decisions in the market, right? So, by the Fed and other
maybe
people,
we can
go ahead.
No, maybe we can drop out of the screen. But I was going to say, I was about to, I think, say exactly what you were about to say. So I just passed.
Yeah. So we need to identify the right thing, because the Fed will talk us into the next recession. The Fed will, mess with our money supply. And if we want control of our money supply, if we want control of our destiny, we need to know the truth, where these price increases are coming from. And also, I've said this recently now, and it's not very popular to say, but price increases that aren't due to money printing, so this is like supply shock stuff, those are informational. Those are good because you can make more proper economic calculations if you have good price signals. The problem is money printing, because money printing creates the inability to know the truth in the economy, because all the price signals are messed up. They're not actual, the truth of the capital allocation out there and demand and all of that stuff. But when you have supply shock, those price increases are informational. They're good. You need to know that information so that you can make proper, economic decisions. So that's all I have for this one. I did have one more chart if we want to do that one. This is a famous chart that we haven't looked at in a while. It's the reverse repo. There you go. The reverse repo, it hit a new record high at 2.22 trillion. And when I look at this chart, I see the dollar milkshake theory from Brett Johnson. And that is where, the dollar is going to get stronger because it's going to suck all the liquidity out of the global financial system. And that's what I think is represented by this reverse repo chart, is people parking money at the Fed, parking liquidity at the Fed. And it keeps going up and up. Now, what's interesting as well is in this press conference, or at this FOMC meeting, they raised the reverse repo rate up to 155 basis points. And that puts it far, far above any sort of Japanese bond, German Bund, all from the 10-year down, 10-year out. It puts it above most of the German long bonds. And so if people are looking for a place to put money, why wouldn't they put it in the reverse repo at the Fed? I mean, it's the safest of the safe bet that you can make. You're lending right there to the Federal Reserve. So I think this is interesting. I expect this to expand, continue to go up. And over the next couple months, we'll probably hear a lot of talk about this. I can see this maybe getting up to 3 trillion within the next couple months. So any reaction to this chart? We haven't looked at it in a while. Christian.
I mean, if I said I was like an expert at, understanding how this fits into the dollar system, I would be lying. That's where I have to really rely on you, Ansel. But I'm curious, does this compete? Like, is this the current store of value? Like, how does this kind of like stack up against other kind of opportunities within the dollar stack, treasury bonds, etc.?
Well, the reverse repo rate at 155 basis points is very far above the 4-week rate. So I looked this morning and the 4-week treasury bill was 1.09%. So this is almost 50 basis points higher than the 4-week treasury bill. And that brings up a question that Jeff Schneider brings up a lot, is how on earth is the 4-week rate below the overnight rate? That doesn't make any sense. Like, why wouldn't you just go to the Fed in reverse repo, and get 1.55 basis points or 1.55% instead of 1.09%. So there's a lot of things that we can take from this. I'll have to do a whole nother show because it, goes in depth, and I could probably talk for 20 minutes on just that. And we got some more clips to get to.
All right. Yeah. So we have a lot more clips to get to. I guess last words before we get into this next clip.
Well, I'll just set up this next clip real quick. So it's past the, he has prepared comment section, and then he goes into Q&A. And so this is part of the Q&A. During this Q&A, people ask him about the unemployment rate, because he says that he wants unemployment to go up. And people don't like that. That sounds really weird. You want people to lose their jobs. So he's asked a couple times about that. And he's talked about inducing recession in this clip. So let's roll the clip, guys.
Hi, Chair Powell. Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
All right, so that was a longer clip. That's the longest one that we have here. I just want to point out that, he did talk a lot about the unemployment rate there and that they need, okay, so you can't have, they don't think that you can have a stable economic recovery if you have too low of unemployment, because the way that they look at it is low unemployment means that there's competition for wages, and that will push wages up, and that will give people more money to spend, and it will be a feedback loop for inflation. So their goal here is to raise unemployment, which is kind of counterintuitive, and I don't think it will work, but that I'm just explaining what they're saying. He also mentioned that they have to control the things that they actually have control over. They, affect the demand side. They can't control oil prices. They can't control those other things like sanctions over there in Europe. So, and the last thing I will say here is he said that we were expecting more progress and we didn't get that. So to me, that's like, okay, well, you were wrong then, you're going to be wrong again. So what's your take there, Christian?
Man, Well, I keep tweeting and talking about this. You know, they're killing the golden goose they never knew they had. You know, this wealth effect that was going to their benefit, they're now killing that, and now the world is seeing that we are in this massive cluster F, and there's nothing the Fed can do, as they admit, about it. Right? There's nothing they can do to fix the oil shortages. There's nothing they can do to fix the supply chain issues. There's nothing they can do to fix the state of the economy. All they can do is manipulate the plebs that are under their jurisdiction with tools that don't even work and end up actually making the situation worse. But yet they have to, you know, straight face lie to you, the Bloomberg journalist's face, by saying that, hey, this is a healthy jobs market and economy, which everyone knows is not true, because I'm driving down the road. I just drove across America, and I keep seeing diners that have signs saying, you know, employees needed, employees wanted, all this work that is available. But guess what? No one who could actually, you know, afford to live on the wages that they're, you know, economically able to pay can even live within that jurisdiction. Or it for whatever reason, it's easier just to get whatever social security or welfare or food stamps than it is to go out and make those very low wages. So I think right now, again, we are in an economic hurricane. I think that the Fed is continuing to make it worse. What they're doing, they admit, can't actually fix the supply chain issues. And I think by inducing a recession, they're just going to put us in a worse situation, and they're also going to expose their inability to actually do anything.
Yeah, I don't have anything to add on that, other than just to say, you know, he's playing semantic games, and this is the first time that I watched Powell where I was like, man, he's not really being honest for the most part in this press conference. So anyway, we have about 20 minutes left. We got to get through all of Lagarde's stuff. So should we jump over to the ECB?
Well, I guess just real quick, do you want to play psychologist on Powell and just talk through like maybe like what you think is going through his head right now?
Well, they're confused. They really do believe that there is this reinforcing cycle with unemployment. And we went through this with Yellen and Bernanke before, where they were really worried about R star, which was maximum employment, or, you know, like the variable for maximum employment. And it never really worked. They were always behind the curve. It didn't, you know, like Powell said here, they were expecting more progress. They were always not getting it right and failing to predict where the economy was going to be just 6 or 12 months ahead. So this is just, they are unable to shift to a new idea. There has been no economic scholarship in the last 20 years, like real progress in economic scholarship. I think all of the economic scholarship has happened here in Bitcoin. And so it might take another 5-10 years, but eventually these central bankers are going to, you know, like Saifedean might become real high up there in the academic literature for economics, because he is making original content. And really the academics at the Fed, they just haven't come out with anything new in a very long time. So that's my kind of take on it.
So you think that this dip is catching Jerome in a tough spot? You know, I would think everyone's in a tough spot because of the dip. Do you think he's in a tough spot?
Yeah, I mean, I think they don't know. They are incapable of really affecting the market. All that they can do is maybe guide it to a soft landing. And so that's what I think they have been trying to do for the last six months or 12 months, really, since they started talking about being hawkish again. So I think they're just trying to maybe raise rates at a fast enough pace so that they have room to cut again. You know, they're just trying to get ahead of the narrative, and that's all they're doing. And so
all right, let's move on.
I don't want to take too much time on Powell.
Yeah, I know we're tight on time. Yeah.
So let's there we go.
High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term. In May, inflation again rose significantly, mainly because of surging energy and food prices, including due to the impact of the war. But inflation pressures have broadened and intensified, with prices for many goods and services increasingly strongly. Eurosystem staff have revised their baseline inflation projections up significantly. These projections indicate that inflation will remain undesirably elevated for some time. However, moderating energy costs, the easing of supply disruptions related to the pandemic, and the normalization of monetary policy are expected to lead to a decline in inflation.
Okay, so here I don't think she said too much substantial. I just wanted to have this opening clip because her kind of cadence and her delivery is so much different than Powell's. And a lot of people might not have ever watched Christine Lagarde talk about monetary policy. So I wanted to give this kind of opening clip. And any reaction right off the bat here, Christian?
No, I mean, pretty classic, and it's interesting to have to completely 180 from less than a year ago when she was saying inflation is transitory, it's not an issue, we have it under control. It's like one punch in the mouth, and it's rampant. And I mean, when they're talking about I find it's crazy because they're talking about they need to bring inflation down with monetary policy. But they also know, and we can refer back to Powell, that they can't actually do something about supply chain issues. So to me, it's crazy that they're calling this inflation. They should just call this price increases due to supply chain breakdowns, and not think that they could actually fix that with monetary policy, because all they're doing is they're actually adding a more chaotic element to the mix, and that's not helping. This is like the key point that we're trying to drill down in. I'll just get off my rant already. I'll keep it short, but the inconsistency remains.
Yeah, and I mean they blame the war, but the war really doesn't stop oil from flowing, right? It's the actual sanctions that they're putting on. So they're once again they're diverting attention away from the left hand so that you don't see what the right hand is doing. Same thing with, hey, this is calling it inflation when it's not, and blaming Russia when they should blame themselves because they are doing the ones doing the sanctioning. So,
but what choice do they have, right? They're not willing to fight. We don't have to talk about this. I just wanted to throw that wrench in there.
Well, I heard something interesting. I can't remember who said it, but it's somebody that I just watched a podcast on YouTube from this morning, and they called it a economic blitzkrieg. And I thought that was a really good way to put it, that they are trying to do war through economics and really they tried to crush the Russian economy with this economic blitzkrieg, but it didn't work. So now we're kind of seeing what the fallout is from that. But anyway, let's move on to the next. Let's move on to the next clip.
Throughout this process, the Governing Council will maintain optionality, data dependence, gradualism, and flexibility in the conduct of monetary policy. First, we decided to end net asset purchases under our asset purchase program as of July 1st, 2022. The Governing Council intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it starts raising the key ECB interest rates, and in any case, for as long as necessary, to maintain ample liquidity conditions and an appropriate monetary policy stance. Second, we undertook a careful review of the conditions which, according to our forward guidance, should be satisfied before we start raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. Accordingly, and in line with our policy sequencing, we intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. Third, beyond September, based on our current assessment, we anticipate that a gradual but sustained path of further increases in interest rates will be appropriate. In line with our commitment to our 2% medium-term target, the pace at which we adjust our monetary policy will depend on the incoming data and how we assess inflation to develop in the medium term. Within the Governing Council's mandate, under stressed conditions, flexibility will remain an element of monetary policy whenever threats to monetary policy transmission jeopardize the attainment of price stability.
All right. Well, I just had to put this in here. I mean, I wonder why they do it in English. You know, like it's obviously now in the EU without England in the EU or Great Britain. Like it's English is everyone's second language. And so like they're given these big monetary policy speeches where they're supposed to convey this very important thing in like everyone's second language. I don't know that I just got that from her cadence and from her, she's just being very slow. Did you notice that, Christian?
Well, I mean, I think that watching English as a language, its dominance insert itself is a good framework to kind of understand how a Bitcoin standard is going to really assert itself over time. Because ultimately it's the constant, and that's why it becomes the standard. And even if it's not the preference for everyone, they want their CBDC bucks or whatever. We'll get to a world where everyone will at least trust Bitcoin enough to accept it, and that's how the standard forms. So I just wanted to make that connection. And in terms of like what she's talking about, I feel like it's kind of interesting watching her follow the Fed. Right? She's effectively 2 quarters behind the Fed in terms of these actions to quell inflation. And I'm interested to see if she's almost being bullied into this behavior when she was effectively saying no, full steam ahead, not very long ago, and the Fed was actually changing its direction to deal with inflation.
Yeah, great observations. She's actually asked that question by the very first question in the Q&A.
Shows how not smart I am or observant. It's just the most obvious thing.
She's asked that question if she's just following the Fed, and should we think of it like that they're just taking the lead of the Fed? And of course she says no, don't think that way, but it totally comes across as they're just 2 quarters behind.
She 180'd so hard, and like she was literally giving the complete opposite opinion when Powell started kind of changing his direction.
Yeah. Another thing I pulled out of this press conference that we didn't have a chance to show because we only had 6 clips here, but they talk about the Fit for 55 and the Repower EU programs. And I'm not familiar with these, but I'm assuming they're climate programs, like some sort of ESG type programs. And what she said specifically was that they're going to make the EU more resilient to global shocks. And I don't think anyone else probably picked up on this, but I call the ECB here Lagarde the Davos crowd. They're the globalists over there, and so they really like globalization, right? They want globalization to continue. They want to be in charge of this globalized rule-based order, and so they really hate deglobalization or any talk of deglobalization. But right here, when she says that these things are going to make the EU more resilient to global shocks. To me, that's almost like letting the mask slip a little bit and show that, yeah, they're almost ready to accept that deglobalization is going to happen. And they are, I don't know, it just seemed like a very big moment to me, because I think of this globalization versus deglobalization all the time. And this struck me as very like in line with deglobalization.
Well, again, it's a complete 180. And just 2 quarters ago, she was talking about globalization, more globalization, and you were effectively laughing at her. I do remember that. Again, listeners, you can go back. We talked about it.
Yeah, something else she said here that's sounding exactly like Powell, again, like you said, is, quote, if demand were to weaken in the medium term, it would lower pressure on prices. So how do you weaken demand? Well, you crush demand by crushing people, crushing consumers, crushing the economy. So it sounds just like the Fed. All right, let's get on to the last clip of the day. This is working out pretty good timing. So this is a short one. And so I wanted to set this up. Yeah, I wanted to set it up real quick, is that it's about fragmentation. She talked about that very briefly in the very first clip that we played. But that is the idea that credit spreads from, the pigs, the Portugal, Spain, Italy, Greece, that these credit spreads will affect these more indebted nations a lot more as the ECB is raising rates, right? And there's this worry about fragmentation within the Eurozone. So she pounds multiple times saying, we are committed to anti-fragmentation. We have different tools. We're going to use all of our tools. But, she never really breaks down what she means by that. But anyways.
We've been talking about the breakup of Europe for a long time on this show, too.
Yes. And the coming European debt crisis 2.0. This is kind of what we're talking about here. But this question that we're going to play, she just is getting frustrated because people keep asking her about this fragmentation. So let's roll the clip.
On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission. And we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances of countries how and when that risk is likely to materialize, and we will prevent it.
We will prevent it. We will not tolerate it, but we're not going to tell you exactly how, but we will not let it happen. So what's your reaction, Christian?
Yeah, just like they can't prevent oil prices from going up, they can't prevent that, but they can create a recession and make the plebs hurt in the meantime.
Yeah, I have an article here that I wanted to read through. So it's because a couple days after this press conference, because this is like almost 2 weeks ago now that Lagarde spoke, and the market did not like it. This anti-fragmentation stuff really kind of hit some bad notes in the broader economy. So the ECB came out and tried to fix it right afterwards. And so I wanted to read this article. This one is from Reuters, and the headline is ECB pledges new crisis tool to help indebted southern states. The European Central Bank promised fresh support for the bloc's indebted southern rim on Wednesday, tempering a market rout that threatened a repeat of the debt crisis that almost brought down the single currency a decade ago. Government borrowing costs have soared in the 19-country currency bloc's periphery since the ECB unveiled plans last Thursday to raise interest rates to tame painfully high inflation. But the bank failed to reassure investors it would contain the rise in borrowing costs, making only a vague pledge and stoking fears it was abandoning more indebted nations, such as Italy, Spain, and Greece, which have struggled for years under the weight of massive debt piles. Reversing course just 6 days later, the ECB said it would direct cash to more indebted nations from debt maturing in a recently ended 1.7 trillion euro pandemic support scheme, and it would work on a new instrument to prevent an excessive divergence in borrowing costs. Quote, the governing council decided to mandate the relevant Eurosystem committees, together with the ECB services, to accelerate the completion of the design of a new anti-fragmentation instrument for consideration by the governing council, the ECB said after an extraordinary meeting. But the ECB chief, Christine Lagarde, also tried to temper expectations, arguing that the ECB's job is taming inflation, not helping budgets. Quote, we cannot surrender to fiscal dominance, Lagarde said at a forum in London. Neither can we surrender to finance dominance. We have to deliver on our mandate, end quote. So that's what's happened since this meeting, and I think it's very interesting. It's going right down step by step down this European debt crisis 2.0, and we called it way back a year and a half ago.
Yeah, no, I don't want to stick long on this, but like think about this idea of both being adaptive but not being able to adapt to like effectively having a mandate first and not a people first policy. You know, like that's a tough place to be. You both have to be, you both control, you don't actually control, but you control by responsibility and by, you know, what people believe you control. By name, you control, you know, what is going to happen. And at the same time, your mandate is not necessarily going to be people first. It's just a tough place to be. And again, like, this is why humanity needs something that isn't controlled or can be controlled or strives to manipulate. Like, this is why we urgently have to get away from this baloney. And this is why I'm so appreciative of Ansel for doing this amazing research and uncovering a lot of, you know, the dialogue, you know, people don't listen to. That they need to, so they understand the intention behind central banking and why it's not a good thing.
Absolutely. I will make everything available for the listeners and viewers in the show notes. So check out the FedWatch the FedWatch podcast feed, and I will be tweeting it out. So you can follow me on Twitter at Ansel Lindner. I also do a companion post that comes out hopefully within a few days of the podcast over on Bitcoin Magazine. But anyway, we will make sure we get you a link to see the charts and to watch these videos if you are an audio listener. So that's all I have today, Christian.
Yo, we got some good shows teed up. I'm really hyped for them. And yeah, I'm hyped to be in the Nashville studio. I'm loving what is going on with Q and P. Y'all can follow me at CK_Snarks, and back to the hosts.